Did you know that missing just the 10 best days in the market over a 20-year period could cut your returns in half? It's like skipping the most important chapters in a book and wondering why the story doesn't make sense. Most investors panic sell at exactly the wrong times, leaving their financial goals in tatters. In this video, I'm sharing the uncomfortable truths about investing that those flashy finance influencers conveniently leave out. No hype, no promises of overnight riches, just actual, proven strategies that work for regular people trying to build wealth systematically over time, regardless of market conditions. The ordinary hero's financial quest. Have you ever felt like you're the only one not making money in the stock market? Like everyone on Reddit and TikTok is turning their lunch money into millions while your investments are doing the financial equivalent of a belly flop? Yeah, I've totally been there too. That feeling of watching others post their gains while you're questioning if you're just financially cursed is basically the first chapter in every investor's story. Think about it like this. When most of us start investing, we come in with these massive dreams. We picture ourselves sipping fancy coffee while casually checking our ever-growing portfolio before heading off to our beach house. But then reality hits. The stocks we were so sure about tank for no apparent reason. The crypto that was definitely going to the moon crashes back to Earth. And suddenly those dreams of financial freedom start feeling more like financial fantasy. Here's something that might make you feel better, or worse, depending on how you look at it. Roughly 80% of individual investors underperform the market over a 20-year period. That's right. The vast majority of people trying to pick stocks and time the market end up with less money than if they'd just bought a boring index fund and forgotten about it. When you hear that stat, it's easy to think, well, what's the point of even trying? But here's where things get interesting. This isn't the end of your story. It's literally just the beginning. What you're experiencing right now is what storytellers call the ordinary world before your hero's journey kicks off. Every great hero starts somewhere totally normal, usually feeling a bit lost. Your desire to build wealth and achieve financial independence is your call to adventure. It's your bank account telling you it's time to start a journey. Like last year, when I put my savings into what I thought was a can't-miss tech stock, only to watch it drop 30% in a week. That moment of panic, staring at my screen in disbelief, that was my call to adventure. It forced me to realize I needed a real strategy, not just enthusiasm. The problem is, most people hear the call but never answer it. They make their first investment, face their first loss, and then retreat back to the safety of savings accounts that don't even keep up with inflation. It's like deciding to stay on a comfortable but unfulfilling path rather than embarking on the journey that could transform your life. What separates those who succeed from those who give up is how they handle the first major obstacle. In investing, that obstacle usually shows up as a market correction, a failed stock pick, or that moment when you realize you have absolutely no idea what you're doing. This is the point where about 70% of new investors throw in the towel. They sell everything, often at a loss, and tell themselves that investing just isn't for them. But you're different. I know because you're still watching this video instead of scrolling to something more entertaining. You're ready to push past that first obstacle, but you need the right tools and mindset shifts to do it. And that's exactly what I'm going to give you. Not get-rich-quick schemes or hot stock tips, but the actual psychological frameworks and practical strategies that can transform you from a frustrated investor into the hero of your own financial story. Let's get something straight, though. The stock market isn't rigged against regular people like us. That's a convenient excuse people use when they lose money. The truth is more fixable. The market simply punishes those who don't understand the rules of the game. It's like trying to play chess when you only know the rules to checkers. You're gonna lose, not because the game is unfair, but because you're playing it wrong. The good news: the rules can be learned. The psychological traps can be avoided. The mistakes that most investors make can be sidestepped entirely once you know what they are. You don't need special powers to succeed. You just need the right approach and a willingness to learn from others' mistakes and your own. The most successful investors like Warren Buffett or Ray Dalio succeeded because they understood the psychological game better than everyone else. They created systems to protect themselves from their own worst impulses. They learned to be greedy when others were fearful and fearful when others were greedy. And you can do exactly the same thing. The tools that separate average investors from exceptional ones aren't complicated financial algorithms or insider connections. They're psychological frameworks and decision-making systems that anyone can implement. Most financial education focuses on the technical stuff: P/E ratios, chart patterns, economic indicators. That's like teaching someone the rules of chess without teaching them strategy. The real difference makers are your mental game, your emotional resilience, and your ability to stick to a proven process even when every instinct is screaming at you to do the opposite. In the next sections, I'm going to walk you through exactly how to develop these capabilities. I'll show you how to structure your portfolio to weather any market storm, how to avoid the psychological traps that ensnare most investors, and how to turn market volatility from something scary into your greatest advantage. My costly defeat. Lessons from losing thousands. Let's get awkwardly real for a second. The market doesn't just punish those who don't understand the rules. It absolutely destroys those who think they've mastered them too quickly. My $10,000 mistake wasn't just a financial setback. It was the investing equivalent of thinking you're ready for the Olympics after watching a few swimming tutorials. Picture this. After months of obsessing over investment books, listening to finance podcasts, and watching enough YouTube experts to make my algorithm think I was Warren Buffett's apprentice, I felt invincible. I'd found this tech company developing breakthrough AI software for healthcare. The research checked out. Their quarterly reports looked promising. The leadership team had solid credentials. Analysts were giving it a strong buy rating. So I put $17,000 into it, about 60% of my entire investment portfolio. I hit that buy button with complete confidence, already mentally spending the profits I assumed would follow. Then came my financial reality check. 2 weeks later, the company announced regulatory hurdles. The stock dropped 15% in a day. Just a temporary setback, I told myself, dismissing the red flag. A week later, a competitor announced a similar product further along in development. Another 20% gone. The real gut punch. A month in, an investigative report revealed accounting irregularities. The stock plummeted to less than 40% of what I'd paid. I lost over $10,000 in 6 weeks on a single position. My thorough research had completely missed these fundamental problems. I became obsessed with that trading app, checking it constantly, hoping for a miracle. My sleep suffered. I couldn't focus at work. I'd walk my dog while staring at candlestick charts, nearly walking into traffic. The shame was suffocating. The mental spiral was worse than the financial loss. Maybe if I just wait longer. Perhaps I should double down at this lower price. What if I sell now and it rebounds tomorrow? Each thought potentially digging my hole deeper. I panic sold when the stock hit 38% of my purchase price. And, predictably, it rebounded about 15% the very next week. But here's where my story shifts. That painful, expensive failure became my tuition paid to the market. It's like training for the Olympics only to realize during your first competition that you've been practicing the wrong stroke entirely. This $10,000 lesson fundamentally changed how I approach investing. It forced me to confront the truth that my psychology, not my research skills, was the biggest threat to my financial future. The humbling part was admitting that despite consuming hundreds of hours of investment content, I had missed the most important aspect: developing psychological discipline. As research shows, successful investing involves a fluid approach to market volatility and understanding the risks involved, indicating that even experienced investors are not immune to making mistakes. The real problem wasn't insufficient research, though it had blind spots. I had overestimated my ability to handle uncertainty. I'd convinced myself I was making a calculated decision when I was gambling based on an illusion of control. This realization led me to a different path of investment education, understanding my psychological weaknesses rather than just learning technical analysis. I studied cognitive biases in the context of investing. I created rules that protected me from my worst impulses. I built systems that forced me to slow down before making decisions. What I discovered is something few investing experts emphasize. The most sophisticated investment strategy is worthless without the psychological framework to execute it consistently. Technical knowledge without emotional discipline is like having a Ferrari with no brakes. Impressive until you hit the first curve. The concept of tuition paid to the market transformed my perspective. Instead of seeing my loss as failure, I viewed it as necessary education. By reviewing past mistakes with an objective mindset, I could analyze whether cognitive biases influenced my poor decisions. This shift transformed my approach to investing. I restructured my portfolio to account for my psychological tendencies. I implemented cooling-off periods before making significant investments. I created decision journals to track not just what I invested in, but why. Over time, these changes improved my returns and transformed my relationship with investing. The market stopped being an emotional roller coaster and became something I could approach with clarity. Not because I suddenly became smarter about picking stocks, but because I became smarter about managing myself. The psychological traps destroying your returns. Here's what I've learned about our prehistoric brains. They were designed for completely different challenges than analyzing stock charts or managing investment portfolios. Think about it. Our ancestors needed mental shortcuts to decide whether that rustle in the bushes was a predator or just the wind. They didn't need to calculate compound interest or analyze market volatility. This evolutionary mismatch is the root of our investing problems. Your brain, with all its amazing capabilities, is running outdated software when it comes to the modern financial world. This affects everyone from the college student with their first Robinhood account to the gray-haired hedge fund manager with decades of experience. The first mental trap sabotaging your returns is loss aversion. Studies show we feel the pain of losses about twice as intensely as we feel the pleasure of equivalent gains. Imagine finding $100 on the street. Pretty nice, right? Now imagine losing $100 from your wallet. That feeling of loss is way worse than the happiness from finding the same amount. This makes us do dumb things with our investments. When a stock we own drops 15%, our brain screams danger, even if nothing fundamentally changed about the company. It's like having a car alarm that goes off during a light rain shower. You panic sell at exactly the wrong time. Meanwhile, when investments go up, we're quick to cash out because a small guaranteed win feels safer than risking it disappearing. The result? We cut winners short and let losers run, the opposite of successful investing. Think about the last time you sold a winning stock. Was it because you carefully analyzed the company? Or was it more like, I'm up 20%, better sell before I lose these gains? That's loss aversion at work. The second trap is recency bias, giving too much importance to what just happened. Your brain is like a historian who only remembers last week's events. This explains why investors pile into sectors that have recently outperformed, often just before they cool off. During the pandemic, everyone rushed to buy Zoom and Peloton when they were already up hundreds of percent. By the time most bought in, these stocks had nowhere to go but down. Recency bias also works in reverse. After a market crash, many investors remain traumatized for years, missing out on recoveries because they're still emotionally responding to the past. Those who sat out the bull markets after 2008 or March 2020 paid a heavy price for this bias. The third trap is confirmation bias, our brain's way of protecting existing beliefs by seeking information that supports what we already think. It's like wearing rose-colored glasses when researching stocks you own. You gravitate toward bullish articles and dismiss negative reviews as haters or short sellers. These three biases form a dangerous cycle. Recency bias might attract you to a trending stock, confirmation bias reinforces your decision to buy, and loss aversion prevents you from selling when evidence turns negative. These patterns show up in market data too. The disposition effect demonstrates how investors are approximately 50% more likely to sell stocks that are up versus those that are down, regardless of future prospects. Data from investment firm Dalbar reveals that from 1996 to 2015, while the S&P 500 returned 8.2% annually, the average equity fund investor earned only 4.7%. Why? Because investors jumped in and out based on recent performance, buying high after good periods and selling low after bad ones. Confirmation bias explains phenomena like home country bias, where Americans typically hold 70 to 80% of their equity investments in U.S. stocks, despite the U.S. representing less than 50% of global market capitalization. We seek comfort in the familiar and justify these skewed allocations. The good news: awareness of these biases is the first step toward counteracting them. But awareness alone isn't enough. You need systems and safeguards that protect you from your brain's faulty wiring. The most successful investors don't try to eliminate these biases. They build processes that work around them. They use automatic investing to avoid timing decisions, implement strict rules for when to buy and sell, and seek out diverse perspectives to challenge their thinking. Some even use technology to introduce friction into the investment process, like mandatory waiting periods before making large trades. Why following your gut is financial demise. Those protective investment systems we talked about aren't just helpful. They're absolutely necessary because there's something far more dangerous lurking in your financial decision-making process. You know that little voice inside your head that whispers, "This stock just feels right," or "The market seems way too high right now"? That intuition you've been taught to trust your entire life might actually be your portfolio's worst enemy. From childhood, we're bombarded with messages about trusting our instincts. Follow your heart. Go with your gut. Trust your intuition. This advice makes sense in many contexts. That gut feeling about a sketchy situation might keep you safe. And intuition about people can help navigate complex social dynamics. But when it comes to investing, that same instinct that helped our ancestors avoid predators actively sabotages your financial future. The brutal truth: market timing based on intuition is essentially financial suicide. The data screams this fact. Your brain wasn't designed to process the massive, complex datasets that influence market movements. When making investment decisions based on how things feel, you're asking a Stone Age processing system to solve quantum physics problems. What makes this dangerous is how convincing our intuition feels. When you get that strong hunch about a stock or market direction, it hits with the force of absolute certainty. This is definitely the bottom. This stock is absolutely going to crash. Your brain delivers these predictions with such conviction that questioning them feels almost wrong. Look at what happens when people follow these gut feelings. Research shows the average investor earns dramatically less than market averages. This performance gap happens because investors let their gut override rational analysis at the worst moments. The pattern is predictable, markets drop, and your instincts scream danger. Your brain floods with stress hormones. Every fiber of your being tells you to sell. Then, after recovery begins, your intuition remains skeptical until the rally is so obvious that fear of missing out finally overwhelms caution. You buy near the top, just in time for the next decline. Consider the 2008 financial crisis. As markets plummeted, millions of everyday investors liquidated their portfolios at the bottom, locking in massive losses. When the recovery began in 2009, many remained on the sidelines, absolutely certain another crash was coming. By the time they felt comfortable reinvesting, they'd missed substantial gains. Our brains create compelling narratives out of random market noise. We're hardwired pattern recognition machines. When looking at stock charts, your brain constructs elaborate stories explaining each movement, creating the illusion of special insight. During the pandemic crash, a friend was convinced he could feel the bottom approaching and invested heavily in late March 2020. Pure luck made him right, but that success convinced him he had a special ability to sense market turns. 6 months later, he moved everything to cash, missing one of the strongest rallies in history. His intuition had created a narrative that felt real, but was completely disconnected from reality. Financial media makes this problem worse. Headlines trigger emotional responses, fear, greed, urgency, that activate gut instincts rather than rational thinking. Markets in turmoil. These bypass logical thinking and aim for emotional triggers. News outlets frame market movements in misleading ways. Markets plunge on inflation fears creates a cause and effect narrative that might be manufactured. The headline makes you feel like you comprehend why markets moved and can predict what happens next. Even professional fund managers with advanced degrees, sophisticated models, and research teams struggle to consistently time the market. If these professionals with every advantage can't reliably predict short-term movements, what chance does your gut feeling have? This is precisely why the decision rules we'll explore in the next section are so crucial. We'll look at systematic investing approaches that protect you from your own instincts. These include rules-based frameworks that determine when to buy and sell without emotional input, automated investments that continue during downturns, and mandatory waiting periods before major decisions. Warren Buffett's famous advice: be fearful when others are greedy and greedy when others are fearful, directly acknowledges that successful investing often requires acting contrary to gut instincts. When markets are plummeting and your instincts scream, sell everything, that's when historical data suggests you should be buying. I'm not suggesting you should never trust your instincts, Just recognize where they're helpful and where they're harmful. Your intuition about a company's product might be valuable if you're an expert in that industry. Your sense that a management team seems dishonest during an earnings call might save you from fraud. But for timing market movements or predicting short-term price action, your gut is actively destructive. The dangerous psychology behind trading apps. Now let's talk about something most people never consider when investing: the actual design of the apps we use to trade. I mean, have you ever stopped to think about why your investing app looks more like a video game than a serious financial tool? That's definitely not an accident. Trading apps have completely transformed how we invest. Remember when buying stocks meant calling a broker on the phone and paying ridiculous fees? Today, you can buy fractional shares of Amazon while waiting for your coffee order with just a few taps. This accessibility seems like an incredible innovation, and in many ways, it is. But there's a darker side to this convenience that's costing everyday investors serious money. These slick interfaces are engineered to be addictive. The same psychologists who help design casino games and social media platforms often consult for fintech companies too. Their goal is keeping you engaged and trading as frequently as possible. The confetti animation bursting across your screen after a trade is a calculated reward mechanism giving you a hit of dopamine, the same brain chemical that makes social media so addictive. Think of your trading app as a sophisticated slot machine in your pocket. Everything from color choices to notification systems is designed to keep you pulling that lever. Bright green when stocks rise creates feelings of success and encourages risk-taking, while alarming red triggers fear and urgency. Those constant notifications saying Stock X is up 3%, or don't miss out on the Tesla rally, create false urgency pushing you to check your portfolio and make trades you otherwise wouldn't. The gamification elements, leaderboards showing top performers, achievement badges for completing trades, reward point systems, tap into our competitive instincts and desire for status. They transform investing from a serious financial activity into a game you feel compelled to win. What makes this especially problematic is that research clearly shows frequent portfolio checking and active trading lead to significantly worse returns for individual investors. When constantly monitoring investments, you're more likely to make emotional decisions based on short-term market movements. That notification about a 5% stock drop can trigger a fear response leading to panic selling at exactly the wrong time. The ease of trading removes important friction from the investment process. Previously, having to call a broker gave you time to second-guess impulsive decisions. Now you can make potentially life-altering financial moves with the same effort as liking an Instagram post. That missing friction is valuable. It gives your rational brain time to override emotional reactions. Here's where the true conflict of interest becomes clear. Most of these free trading apps make money from your activity, not your success. They earn revenue through payment for order flow, margin lending, and subscription upgrades. The more you trade, the more they make, even if that trading activity destroys your returns. They have every incentive to design platforms encouraging maximum engagement, even though that's often exactly opposite to what would benefit you as an investor. If these platforms truly had your financial interests at heart, wouldn't they design features encouraging long-term thinking and discouraging impulsive trading? Instead, we get confetti and push notifications. This doesn't mean avoiding these platforms entirely. They do offer legitimate benefits like low costs and accessibility. The key is using them consciously, recognizing the psychological traps they set. Here's what you can do. Turn off notifications completely. Set specific times to check your portfolio. Once a month is plenty. Use automatic investments to avoid the emotional roller coaster of manual trading. And remember that investing isn't a game, it's your financial future. You might think, I'm aware of these tactics now, so they won't affect me. But awareness alone isn't enough. These psychological triggers work on a subconscious level. Even knowing about them doesn't make you immune. That's why you need concrete strategies to protect yourself from these manipulative design elements. Some investors take stronger measures, using a separate phone without trading apps for daily use, only accessing investment accounts from a desktop computer in a specific location, or using specialized apps that restrict access to trading platforms during emotional market periods. These might seem excessive, but they acknowledge the powerful psychological forces these apps employ. Market myths that keep you poor. Let's shift gears and talk about something that might shake up everything you think you know about investing. Those psychological tricks in trading apps aren't the only thing messing with your returns. Have you ever stopped to question if those fundamental truths about investing you learned from your parents, the news, or even financial advisors are actually based on facts? Because spoiler alert, many aren't. These investing myths are passed down through generations, repeated at family dinners, and reinforced by clickbait financial headlines. Your uncle warning you to never invest when the economy is bad, or your coworker insisting investing is just gambling for people in suits, are spreading financial folklore that could cost you serious money. These myths can shave hundreds of thousands off your retirement savings over your lifetime. First, let's demolish the myth that the stock market follows the economy. This seems logical. Good economy, stocks go up. Bad economy, stocks tank. But the reality is that the stock market and the economy often move in completely opposite directions. Take 2009, for example. The U.S. economy was in shambles, shrinking by 4.3%. Meanwhile, the S&P 500 gained a massive 23.45% in price return. If you had stayed on the sidelines because the economy is terrible, you would have missed one of the best market rebounds in history. Why? Markets are forward-looking while economic data tells you what already happened. When you hear about GDP numbers or unemployment rates, that's yesterday's news that the market already priced in weeks ago. The market constantly places bets on where things are headed, not where they've been. Timing investments based on economic headlines is like driving by looking only in your rearview mirror. Next, let's tackle the dangerous myth that investing is basically gambling. Yes, both involve risk and potential reward, but that's where the similarities end. Gambling is a zero-sum game. For you to win, someone else loses. The stock market generates wealth for multiple people simultaneously as companies grow and create actual value. At casinos, odds are mathematically stacked against you. With investing, particularly in broad market indexes over long periods, the odds are tilted in your favor. Your $100 at the blackjack table has a predictable negative expected value. That same $100 invested in a diversified portfolio has a historically positive expected value if you stay the course. The third myth keeping people financially stuck. You need a lot of money to start investing. This is particularly damaging because it keeps many people sidelined during their most valuable investing years. The truth: you can start investing with just a few dollars thanks to fractional shares and commission-free trading. What matters far more than your starting amount is developing the habit of consistent investing and giving your money time to compound. A person investing $50 monthly in their 20s will likely end up with more money than someone who waits until their 40s to invest $500 monthly. Moving on to another persistent myth. Gold is always a safe haven when stocks crash. Historically, gold and stocks have shown a low or negative correlation. But during the pandemic, something unexpected happened. Gold became more closely correlated with stocks. More recently, gold has exhibited a high positive correlation with stocks as investors hedge against geopolitical risks. This means your portfolio insurance might not work when you need it most. Another damaging belief is that past performance guarantees future returns. That hot stock crushing it for years seems like a sure bet to continue. But markets evolve, conditions change, and yesterday's winners often become tomorrow's underperformers. During the tech bubble of the late 1990s, investors poured money into tech stocks based on their recent performance, only to see massive losses when the bubble burst in 2000. Finally, let's address the myth that value investing is dead. This gained traction as growth stocks dominated during the tech boom. But in many regions outside the US, value has actually outperformed growth over the past 3 years. In Europe and Japan, the outperformance has been meaningful. Far from being obsolete, value investing remains relevant and deserving of investors' attention. Understanding these myths isn't just about avoiding misinformation. It's about protecting your financial future. By recognizing these false narratives for what they are, you can make clearer, more rational investment decisions that could mean the difference between struggling in retirement and building lasting wealth. The sleep at night portfolio structure. Those value investing strategies shine, but here's the uncomfortable truth. Even Warren Buffett's stock-picking magic won't save you if your overall portfolio lacks structure. What separates the investors who sleep peacefully during market meltdowns from those who panic sell at 2 a.m.? It's about having a rock-solid portfolio structure that transforms market crashes from nightmares into golden opportunities. Let's get real about something most investment gurus never talk about. Your individual stock picks matter way less than how your entire portfolio is. Organized. Most investors fixate on finding the next Amazon or Tesla, while their overall portfolio has zero coherent strategy. Think about it. How many times have you heard someone brag about a stock that doubled, only to discover their overall portfolio is actually underperforming? That's because they're playing the hot stock lottery, instead of building a structured approach. The three-bucket portfolio structure changes everything. Instead of a chaotic collection of investments, you organize everything into three clear categories. 1. Stability bucket. This includes bonds, cash, and other less volatile assets that maintain value when markets plummet. Think of this as your financial shock absorber. For example, during the 2008 crash, quality bonds actually gained value while stocks were in freefall, giving investors a reliable resource to draw from. 2. Growth bucket. Primarily broad market index funds that capture the overall market's long-term upward trajectory. These are the workhorses that consistently build wealth over decades through the power of compounding. A simple S&P 500 index fund here would have turned $10,000 into over $30,000 in the decade following the 2008 crisis. 3. Exploration bucket, where your carefully researched individual stocks and specialized investments live. This is where you express your convictions about specific companies or sectors, but only with money you can afford to see fluctuate dramatically. What makes this structure powerful is how it transforms your psychological relationship with market volatility. When the market crashes, as it will repeatedly throughout your investing lifetime, your stability bucket means you're not forced to sell anything at disaster prices. Meanwhile, your exploration bucket might take a beating, but since you've mentally prepared for that possibility, you won't panic. Market downturns become rebalancing opportunities rather than panic moments. Instead of selling in fear, you strategically move money from your stability bucket into discounted assets in your growth and exploration buckets. The allocation between buckets shifts based on your personal situation. In your 20s and 30s, 60 to 70% growth, 20% exploration, 10 to 20% stability. By your 50s, 30 to 40% stability, with reduced percentages in the other buckets as your time horizon shortens. Adjust further based on risk tolerance. If market swings keep you up at night, increase your stability bucket regardless of age. During the COVID crash of March 2020, investors with the three-bucket approach had cash reserves ready in their stability bucket. When the S&P 500 plunged 34%, they didn't panic sell. Instead, they used pre-established rebalancing rules to methodically move money from stability into the suddenly discounted growth and exploration buckets. When the market rebounded dramatically, they captured those gains instead of sitting on the sidelines. The same advantage played out during the 2008 financial crisis. Investors with proper portfolio structure had the psychological security to stay invested, or even buy more, when stocks were down over 50%. This systematic approach helps implement one of the market's oldest pieces of wisdom. Be fearful when others are greedy, and greedy when others are fearful. With structure, this becomes almost automatic. Your rebalancing rules force you to buy more of what's down and trim what's up. The three-bucket approach also simplifies decision-making during stressful market periods. Instead of analyzing each holding individually during a crash, you simply refer to your predetermined allocation targets. If your growth bucket has fallen below its target percentage, it's time to add more from your stability bucket. This structure serves as a defense against the tendency to chase performance. When tech stocks are soaring, they might grow to dominate your exploration bucket. Your rebalancing rules would then require trimming them back, forcing you to take profits rather than overloading on what's currently hot. By clearly separating your speculative investments from your core holdings, you can better analyze what's working and why. Many investors fail to learn because their portfolios are so disorganized that they can't distinguish between skill and luck in their results. Starting small, the minimum viable portfolio. The three-bucket structure isn't just about organizing your money. It's about making investing accessible to everyone, regardless of bank account size. If you're nodding along to everything we've covered but secretly thinking, This sounds great, but I barely have enough for takeout this weekend. I've got news that might change your financial future. Learning from market cycles with a properly structured portfolio is powerful, but here's the truth most finance gurus won't admit. The typical 25-year-old investing just $50 monthly will likely outperform someone who waits until 35 to invest $500 monthly. This demonstrates the mind-blowing math that makes starting early completely crush starting late, even with smaller amounts. Let's debunk the "I need thousands to start investing" myth. This outdated belief keeps countless people on the sidelines of wealth building. The financial industry has dramatically lowered barriers to entry with fractional shares and low-cost index ETFs that have minimal expense ratios, making investing accessible with whatever you can spare. The power of early investing becomes clear when we look at the numbers. If you start at 25 investing $50 monthly with a 7% average annual return, by age 65 you'll have about $122,500. Compare that to waiting until 35 to start investing $500 monthly, 10 times more each month. By 65, you'd have about $619,000. Impressive, right? But that 25-year-old who started with $50 contributions and increased them by just 10% each year would accumulate over $1.1 million by 65. The math overwhelmingly favors early starters. Picture this side by side. Age 25 starter. $50 per month, $122,500 by age 65. Age 35 starter. $500 per month, $619,000 by age 65. Age 25 starter with 10% annual increases. $50 per month, $1.1 million by age 65. The benefits extend beyond numbers on a spreadsheet. Starting small builds psychological resilience. When you begin with $50, market drops don't feel threatening. Losing 30% of $50 is just $15, about the cost of a movie ticket. These small-stakes experiences strengthen your investing confidence in a low-pressure environment. I remember when I first grasped this concept. I had been putting off investing because I thought my small contributions wouldn't matter. Then I ran the calculations and realized that starting with just $25 per week would completely transform my future net worth. That moment changed everything. I stopped waiting for someday and started immediately. Dollar cost averaging becomes second nature when you start small. This approach reduces your average cost per share over time as you automatically buy more shares when prices are low and fewer when they're high. Research shows this strategy helps investors maintain their investments through market volatility. Financial education sticks better when you have skin in the game. Studies show that people who actively invest while learning financial concepts demonstrate significant improvements in their retirement planning behavior and achieve better performing portfolios. Your monthly investment grows both your money and your financial literacy. Getting started is simple. First, choose a brokerage with no minimum investment requirements and free trades. Second, set up automatic transfers from your checking account. Make it small enough that you won't notice it. $25 or $50 bi-weekly works well. Automation removes the friction that prevents consistent investing. Third, select one or two broad market index funds for initial investments. A total U.S. market fund and perhaps an international market fund give you instant diversification. Start with the growth bucket from our 3-bucket approach. Fourth, ignore the investment for at least 3 months. This breaks the habit of checking daily and helps establish investing as a long-term habit rather than an exciting activity. Fifth, gradually increase your contribution amount. Each time you get a raise or reduce an expense, bump your investment by 5 to 10%. This approach transforms lives. People go from investing tiny amounts to building substantial portfolios because starting small eliminates the psychological barriers that keep most people waiting for enough money. Starting small provides another advantage. You make inevitable rookie mistakes with less at stake. Everyone makes investing errors at first. Better to learn those lessons with $500 on the line instead of $50,000. The biggest wealth-building superpower is time in the market, available only to those who start now. Wall Street often makes investing seem complicated, but consistency and patience with small amounts outperform most sophisticated strategies that start later. Think of your minimum viable portfolio like fitness. You wouldn't wait until you can run a marathon before exercising. You start with what you can do today, knowing consistency matters more than intensity. The same applies to investing. Starting with the only metric that builds the foundation for tomorrow's
Just like
financial
that fitness
strength. Routine builds strength over time. There's one magic number that matters more than any fancy stock picking strategy you could ever learn. While everyone's getting distracted by technical patterns and financial ratios with weird names, most investors are completely missing the metric that actually transforms mediocre investments into serious wealth-building machines. You know the feeling. You start researching stocks, and suddenly you're drowning in information. PE ratios, moving averages, RSI indicators, dividend yields, free cash flow, debt-to-equity ratios. Financial media constantly highlights these metrics as if mastering them will unlock some investing superpower. Soon you're spending hours creating spreadsheets to track dozens of numbers that might not even move the needle on your returns. Here's the brutal truth. Most of these metrics are just noise. Total distractions from the one number that actually predicts your investing success better than everything else combined. And the crazy part, it's not some complex formula only Wall Street insiders understand. It's something completely within your control. The metric I'm talking about is your investment time horizon. Literally how long you can keep your money invested without needing to touch it. That's it. This single number has more impact on your long-term returns than any stock-picking strategy, market timing technique, or technical analysis you could ever master. The math behind this is actually mind-blowing. When your investment horizon stretches beyond 15 to 20 years, something magical happens to the risk profile of even volatile investments like stocks. The probability of positive returns approaches nearly 100% as your time horizon extends, especially with diversified portfolios. The longer you stay invested, the more the odds dramatically shift in your favor. This perspective transforms how successful investors approach the market. As Peter Lynch, one of the most successful fund managers in history, powerfully stated, "The price at which you bought a share was not important. How long you held it was what mattered." This completely flips the script on what most investors focus on. While everyone obsesses over entry points and perfect timing, the real pros understand that your time in the market utterly overshadows your timing of the market. This isn't theory, it's backed by hard data. Historical market performance across various presidential administrations since 1929 shows that despite recessions, wars, scandals, and technological disruptions, the S&P 500 has generally posted positive returns across most presidential terms. The only real exceptions? Presidencies that ended during deep recessions. What's fascinating is that monetary policy cycles have historically shown more correlation with market performance than which political party controls the White House. Following the end of Federal Reserve tightening cycles, the S&P 500 has delivered double-digit gains in 6 out of the last 7 instances in the one-year period after the last rate hike. Your investment time horizon completely changes how you should approach portfolio construction. When you're investing for decades rather than months, your entire strategy shifts. Market volatility becomes less of a threat and more of an opportunity. Those scary 20% market drops? They're actually massive buying opportunities when your time horizon is measured in decades rather than days. I've seen this play out in my own investing journey. During the 2020 market crash, while friends panicked and sold at the bottom, those of us with long-term perspectives saw it as a rare chance to buy quality companies at discounted prices. 3 years later, the difference in our outcomes was staggering. This single metric should drive every investment decision you make. Someone with a 30-year horizon can take substantially more calculated risks than someone with a 5-year horizon. It affects everything from your asset allocation to which specific securities you select. How do you actually extend your investment time horizon? First, create separate buckets for different financial goals with different timelines. Money needed in the next 3 to 5 years should be in conservative investments, while funds for retirement in 30-plus years can be invested more aggressively. Second, build an adequate emergency fund so market downturns don't force premature selling. Third, automate your investments so they continue regardless of market conditions, removing emotional decision-making. Your investment horizon is the most powerful risk management tool available. When markets crashed in 2008 or March 2020, investors with long-time horizons who stayed the course saw their portfolios not only recover but reach new heights. Meanwhile, those who couldn't maintain their time horizon locked in permanent losses. The beauty of this approach is that it works regardless of your investment style. Whether you prefer individual stocks, index funds, real estate, or any other asset class, your time horizon remains the most critical factor determining your success. So next time you feel overwhelmed by complex financial metrics or panicked by market volatility, remember, the most important number isn't on any financial statement. It's how many years you can stay invested. Master this one number, and you've unlocked the true secret to investing success that most people miss entirely. AI and the future of regular investor advantage. Time horizon might be your superpower, but what if I told you artificial intelligence is now doing for regular investors what expensive advisors used to charge thousands for? The days when Wall Street bros had all the good data while the rest of us were left guessing are rapidly disappearing. Remember when investing felt like showing up to a gunfight with a butter knife? Wall Street professionals with their Bloomberg terminals, research teams, and insider connections had overwhelming advantages. They could process mountains of data and execute trades in milliseconds, while regular investors struggled to understand basic terminology. The deck was stacked against everyday people. But we're living through a revolution that's democratizing sophisticated investment tools. The analytical firepower that used to cost tens of thousands of dollars is now available through AI platforms, giving regular folks capabilities that would make a 1990s hedge fund manager jealous. Think about it. Firms like Amundi, Wealthfront, and Vanguard are building AI-powered platforms that create custom portfolio recommendations based on your personal risk tolerance. This is personalized strategy development that previously required a team of analysts and minimum investments of several $1 million. Take Sarah, a teacher who invested her savings in what she thought was a diversified portfolio. Using an AI investment platform, she discovered she was heavily overexposed to tech stocks through various ETFs and mutual funds. The platform identified this concentration risk in seconds and suggested specific adjustments to achieve true diversification across sectors, analysis that would have taken hours manually or thousands in advisor fees. These tools address your psychology too. AI systems can analyze your trading patterns and flag emotional decisions. Imagine getting a notification saying, "Hey, it looks like you're panic selling during a market dip. This pattern has cost you money in the past. Want to reconsider?" That's essentially having a financial therapist and investment advisor combined. The analysis extends further. These platforms spot when you might be overexposed to certain sectors without realizing it. AI can identify these blind spots instantly, showing you risks you weren't aware of taking. What makes this shift particularly powerful is how these platforms use data from thousands of client interactions to gain real-time insights. Investment managers can see patterns across their entire client base, allowing them to tailor recommendations that fit what people need now, not what worked in theoretical models from years ago. Companies like Invesco and WisdomTree leverage this kind of AI to develop personalized marketing for their clients, focusing on understanding your needs rather than pushing random products. The best part, you don't need to understand the complex algorithms working behind the scenes. These tools are designed with interfaces that make complicated concepts accessible without oversimplification. However, these AI tools have important limitations. They're only as good as their training data. If that data contains historical biases or doesn't include unique economic conditions like today's, their recommendations could be flawed. There's also the risk of over-optimization, strategies that worked perfectly in backtesting but collapse under actual market conditions. Markets are influenced by human psychology, geopolitics, and countless unpredictable factors that algorithms can't perfectly model. Remember, too, that AI tools serve the companies creating them. With free investment tools, if you're not paying for the product, you might be the product. Some platforms might nudge you toward higher fee products or encourage frequent trading that generates commissions. To use these AI tools effectively, approach them as enhancers of your decision-making, not replacements for judgment. They should complement your thinking by checking assumptions, spotting patterns, and generating ideas you might have missed. Be selective about which AI tools you trust. Look for platforms transparent about their recommendation process and data sources. The best ones explain their reasoning rather than giving black box answers. Use multiple AI perspectives, just like you'd get second opinions from human advisors. When several systems point to the same conclusion, that signal deserves attention. Finally, the most powerful approach combines AI with human judgment. The technology handles data processing and pattern recognition, while you provide context, values, and life goals that no algorithm fully understands. Your investment decisions should align with your personal situation, not just mathematical optimization. We're witnessing a fundamental shift in financial tool access. For decades, the finance industry operated like an exclusive club with steep entry fees. Now AI is bringing regular people through the VIP entrance, democratizing capabilities once reserved for the wealthy elite. The 72-hour portfolio rescue plan. With all these fancy AI tools now at your fingertips, your portfolio might still be looking like a chaotic junk drawer of random investments. While everyone's out here talking about the latest tech stocks and crypto coins, most people are sitting on collections of investments that make absolutely zero sense together. The good news? You don't need a finance degree or an expensive advisor to fix it. I've got a 72-hour rescue plan that can transform even the messiest investment situation into something that actually works for you. Let's be real. Staring at your messy portfolio feels about as fun as cleaning out your garage. Most people would rather ignore the problem, hoping their random collection of stocks and funds will somehow magically organize themselves. But here's the brutal truth. Every day you delay fixing your portfolio structure, you're leaving money on the table. It's like driving with your parking brake on. You might still be moving forward, but you're creating unnecessary drag on your returns. So here's my 3-day rescue plan that anyone can follow, no matter how intimidating your current investment situation might seem. Day 1. The Honest Portfolio Audit 1. Export all your holdings from every account into a spreadsheet. Include those random shares your uncle gave you, old 401k, everything. 2. Categorize each investment by type. Stocks, index funds, bonds, cash, and what even is this? 3. Identify overlap. Many people own multiple S&P 500 funds or similar tech stocks without realizing it. 4. Calculate your true asset allocation. Add up the actual percentages of stocks, bonds, cash, and alternatives. Break stocks down by size, geography, and sectors using tools like Morningstar's X-ray. By evening, you'll have a clear picture of what you actually own, not what you think you own. For most people, this reality check is eye-opening, like discovering your balanced diet is actually 90% pizza. Now that you understand your current situation, it's time to create structure. Day 2. Implementing the 3-bucket structure 1. Decide what percentage each bucket, stability, growth, exploration, should be for your situation. A 30-year-old might choose 15% stability, 70% growth, 15% exploration. Someone nearing retirement might prefer 40% stability, 50% growth, 10% exploration. 2. Make 3 lists. Investments to keep, sell, and buy. 3. Be ruthless about selling investments that don't fit, even if they have emotional value. 4. Fill your buckets appropriately. Low-cost index ETFs for growth, quality bonds and cash for stability, and carefully research stocks for exploration. The hardest part of day 2 is letting go of investments that don't serve your overall strategy. Remember, you're building a coherent system, not a collection of greatest hits. With your new structure in place, let's make sure it stays that way. Day 3. Automation and Rules 1. Set up automatic investments that maintain your target allocations. Most brokerages allow recurring investments with specific percentage allocations. 2. Create a rebalancing schedule, quarterly, or when any bucket drifts more than 5% from its target. 3. Establish decision rules for future actions. If I want to buy an individual stock, I must sell something else from the exploration bucket. If the market drops 20%, I will move 5% from stability to growth. I will only check my portfolio on the 1st of each month. 4. Document everything, your starting point, decisions, and rules, creating your personal investment policy statement. These rules act as guardrails, keeping you from making impulsive decisions during market turbulence. What makes this 72-hour plan so powerful is how it transforms investing from an emotional roller coaster into a methodical process. You'll stop reacting to every market movement or headline and start following a system that works. Most people spend more time researching their next vacation than organizing their investment strategy, even though one determines your entire financial future. This 3-day investment isn't just optimizing returns, it's taking control of your financial life. Imagine the relief of finally having a portfolio that makes sense, where every investment has a purpose, working together toward your goals. That peace of mind alone is worth the 72-hour commitment. Your future self will thank you for taking these 3 days to transform financial chaos into clarity. The missing 10 days that destroy returns. Taking control of your financial life isn't just about organization. It's about showing up consistently, even when every instinct screams at you to run away. Here's the mind-blowing reality most financial advisors don't emphasize enough. Being out of the market for just 10 specific days over a 20-year period could literally cut your returns in half. This isn't some theoretical concept. It's the financial equivalent of missing your flight by 5 minutes and watching your dream vacation disappear. Let's talk about that irresistible temptation we've all felt. The stock market drops 3% in a day, financial headlines scream about market bloodbaths, and your brain whispers, maybe I should move to cash until things calm down. It feels logical and responsible. Why wouldn't you protect your money during scary times? This protective instinct feels right, but it's potentially one of the most expensive financial mistakes you'll ever make. J.P. Morgan's study of the S&P 500 from 1999 to 2019 reveals the painful truth. A $10,000 investment over that period would have grown to about $30,000. But miss the 10 best performing days? Your return gets slashed in half. Miss the best 20 days? Your returns drop by almost 2/3. Miss the best 30 days out of 5,000 trading days? You'd barely make any money at all. Imagine working diligently for 20 years, saving and investing faithfully, only to discover you've earned just a fraction of what you could have. All because you stepped away from the market during a few critical moments of panic. It's like spending years rehearsing for the performance of a lifetime, then missing your cue and standing off stage while your replacement gets the standing ovation. I'll just avoid the bad days and make sure I'm invested on the good ones. If only it worked that way. The market plays a cruel joke on us. The best days and worst days are inseparable companions. During the 2008 financial crisis, the Dow Jones jumped 936 points, 11.1%, on October 13th, one of the biggest single-day gains ever, right in the middle of the financial apocalypse. Similarly, on March 24, 2020, amid the pandemic crash, the market suddenly surged 9.4% in a single day, while COVID cases were still exploding and lockdowns intensifying. The mathematical reality makes timing impossible. 6 of the 10 best days in the market over the past 20 years occurred within 2 weeks of the 10 worst days. This creates a painful paradox, like trying to catch a sunset without experiencing the dusk. The strategy that feels safest, moving to cash during scary times, virtually guarantees you'll miss the rebounds that make all the difference to your long-term wealth. Huge market drops create the conditions for huge market rebounds. Prices get so depressed that even a small improvement in outlook can send stocks soaring. So what's the alternative? Instead of trying to dodge the market's worst days, smart investors embrace volatility and use it as an opportunity. They understand that market crashes aren't bugs in the system, they're features. They're the price we pay for the long-term wealth-building power of stocks. This is where that 3-bucket portfolio structure becomes your psychological lifeline. Having your assets properly divided between stability, growth, and exploration means you're not making decisions from a place of panic. When markets tank, you can actually get excited about rebalancing, selling some from your stability bucket to buy more in your growth bucket at discount prices. This is how wealthy investors make market volatility work for them. Volatility harvesting turns market swings from enemies into allies. Instead of trying to time the market, you use volatility systematically by rebalancing your portfolio when it drifts from your target allocations. When stocks drop, this strategy has you buying more. When they surge, it has you taking profits. No emotion, no guesswork, just a mechanical process that makes volatility your friend. The mindset shift required is massive. See market drops as inevitable parts of the wealth-building process, like viewing rainstorms not as inconveniences, but as essential for growing crops. Without the occasional market downpour, the returns wouldn't be nearly as good over time. Having a written investment plan created during calm times gives you something to follow when emotions run high. This isn't feel-good advice. It's the difference between building wealth and sabotaging yourself repeatedly. Some of the world's most successful investors, like Ray Dalio, don't succeed because they can predict market movements. They succeed because they've built systems that work regardless of what the market does next. They've accepted that trying to avoid temporary losses guarantees missing permanent gains. So here's the thing about your investment journey. It's about learning to sail through storms. When you shift your mindset from victim to hero, everything changes. Instead of feeling helpless when stocks tumble, you'll see opportunities for growth. Every setback becomes a plot twist in your hero's journey. The most successful investors use challenges to level up their skills and understanding. Financial freedom requires commitment to your strategy and emotional discipline. Today, embrace this transformative mindset. When you face market volatility with confidence rather than fear, you've already unlocked the most powerful